Hello and welcome everyone. Thanks so much for joining us for today's State of Freight webinar presented by Uber Freight. My name is Julia Becker. I'm the Senior Content Marketing and Account Manager here at FreightWaves. I'm joined as always in the studio by FreightWaves founder and CEO Craig Fuller and FreightWaves Head of Freight Market Intelligence, Zach Strickland. Today we'll be discussing things from our Sonar platform, and then we'll also be taking a forward look at 2024. But before we get started, I want to cover just a couple of quick items. First, if you have any issues during the webinar, you can reach out to our team via the audience chat function in your webinar console, and we'll be in touch to assist. If you have questions for Craig and Zach, remember you can enter those through that Q&A box also in your console, and we'll be taking questions at the end of our conversation today. We'll also be sending a link to the recording tomorrow if you want to view it on demand or share it with your colleagues. And now I'll go ahead and turn it over to Zach to kick us off on today's discussion.
Thank you for that, Julia, and thank you for tuning in to this webinar. Thank you for Craig for joining. I want to go ahead and kick things off because I think the storyline of the year has obviously been one of abundant capacity in the freight market. But underlying that has been actually a pretty decent demand side environment. And I think one of that's a very challenging thing to say to especially the transportation service providers. Our outbound tender volume index has been strong to quite strong in the month of December. I think when we've talked about this in the past couple of months, we were almost kind of like, this is weird. Like it shouldn't be this way, because normally supply and demand is a little bit more in balance, and demand side nuance is manifested in a tighter market, correct?
Yeah.
So I guess I want to get your take here, Craig, on how you see this playing out, because demand strength has been somewhat irrelevant. But do you think that this is something that will maintain? Do you think it's something we'll actually feel or see?
Well, I wouldn't say irrelevant, because I think you're making a conclusion that a lot of freight people have made, which is that volumes are soft. I mean, the word freight recession has gotten, people have come out and countered that concept because they're like, wait, volumes are actually pretty good. How do you describe this as a recession? So I think, maybe one of the things that we could take the lead on is trying to define what a freight recession really is and what it's not. At the end of the day, there's so many different definitions of it, but I think we have to look at sort of the state of volume. From a macro standpoint, we should pull this chart up. The volumes have actually been pretty solid this year. And, in fact, if you took out the COVID extremes and we talk about, late 2020 and 2021 and early 2022, this actually looks like a pretty strong year. The reality is that 2023, since the start of it, that's that white line going up the chart from January to now to December. You see, if you took out the holidays, and those big dips are all holidays, it's a continuous move up the chart, up and to the right. That's a really strong year. We had a little bit of softness in October related to the strike. But nothing really. I think there was a little concern that peak was going to be off, but obviously November said, hey, wait a second, I'm here. And really from mid-November on, we've seen much stronger conditions in the freight market, and it's starting to appear as if the market's returning. I do want to point out that from a macro standpoint, because we have folks that tune into our data that are on the macroeconomics part of the decisioning. We have folks that tune in that are a part of, financial hedge funds, trying to understand what we're seeing. From their perspective, volumes have been strong. And from a macro standpoint, the economy has been stronger than any of us would have guessed. The problem with that, and we talk about this, and this is starting to sound like a broken record, is that for freight professionals, it does not feel that way. And the reason it does not feel that way is the market has been oversupplied with capacity. And we can talk about that for the next 30 minutes, but I don't think we have to, because I think the folks that tune into this and recognize that the market is way oversupplied, there's way too much capacity in the market, but volumes are stronger. And I think the question that we should be asking ourselves, since this is the last show we will have before the end of the year, it also happens to fall within the day after of the Fed decision.
Right.
I think we can talk about next year being far more bullish for everybody. Capacity is going to continue to burn off. It looks as if the U.S. goods economy, and I don't refer to the service economy
Right.
as an important part. It's important, but not as important as the goods economy. It doesn't impact freight, but it does impact broader economic activity. It does not appear that the economy is going to roll over and end up in a recession. And the crazy thing was, I was probably one of the more bearish people about the overall broader economy earlier this year, because I was looking at all of the reasons of why the U.S. economy could slow down and looking at the softness in the freight data and thinking that would play out much further. It did not.
Right.
And so we certainly got that wrong. But what we certainly understand is that it looks as if the freight economy is coming back.
Yeah, I think the chart that helps explain this a little bit more clearly is the one that I want to pull up here, the Outbound Tender Volume Index versus the FMCSA operating authorities data. And this, I think, tells the picture. I mean, it's obviously not a perfect measure of capacity. The orange line you're looking at there is the carrier details measure of FMCSA operating authorities that are active right now. And you can see that since about December of 2019, we've had over or close to a 40% growth in that figure, whereas freight demand, we're up about 14%. And I think that, to me, tells the story. Like I said, this is not measuring trucks, it's measuring operating authority growth. So this, to me, Craig, helps kind of display the story of the freight market environment possibly better than any other at this point, because we have this huge glut of capacity.
Well, the freight demand,
right,
you're talking about the freight demand.
No, I'm talking about, so the orange line, obviously that represents supply.
Well, we know that's supply, but you're talking about the white line.
The white line is demand.
And it is, I mean, look, I just think it's really interesting how it has continued since the early part of the year. This chart really shows it better than the last chart we showed.
Yeah, it's very unique.
Is since the start of the year, it has been up and to the right. With that October lull that you see in the chart, October becomes obvious. And remember, we were like, whoa, this is like suddenly slow down. But it has continued to really increase. What I think is really interesting is, to your point about capacity, if you go back and look at this chart and go back and remember about the time during the COVID cycle, I read this really interesting article, by the way, and it talked about how people have amnesia about COVID because they're so stationary doing the same thing. It's Groundhog Day every single day that it's a massive blur. So people may not remember the context of what was happening. It was not a blur for me. And I remember sort of looking at mid-year 2020 when we were writing articles and talking about the sort of bullishness. But look at the chart, the delta between where the volume growth entered and the number of trucks. If you considered starting 2020 in the market was in balance, and remember, that came off of the freight recession where we had a lot of bankruptcies, but it felt like the market was in balance when we came into 2020.
It was definitely showing signs of being
close. And so I think this is actually a very fair chart to show relative capacity versus volume, simply because that was a really sort of momentous time in terms of balancing. But if you look at the volume increases throughout the COVID cycle, you can really see how this all played out. And in fact, you see the collapse of it happen in 2022 versus capacity. And I think what's also interesting, which we've talked about before, is capacity continued to build all the way through the third quarter. And it wasn't until we sort of got through the end of the year into fourth quarter before it sort of tailed back. And now we're seeing a situation where at some point, those lines should cross. I think the momentum of the burn-off of capacity is going to continue. That looks like a very sort of a line that will continue downward. The volume, assuming the U.S. economy continues at the same pace, and we should, arguably, if you believe that monetary policy drives so much of the economic activity, arguably, the Fed's willingness to cut rates is suggesting that, not that they're going to stimulate the economy, but it's going to loosen up monetary conditions, which is going to drive some of the activity in the market. And that should be more bullish for economic activity and freight demand. And let's remember, it's a couple of core industries that really drive freight. It's housing, is a massive driver of freight. Autos is a big driver of freight. It has actually done well relative to other parts of the freight economy. You also have industrial activity, industrial plant expansion, CapEx. You have a lot of parts of the economy that are actually interest rate dependent or interest rate sensitive. And that, because of those elements, is going to really impact how we may get some real increase in consumer activity next year in those big categories. I bought a finance business for aviation, for aircraft finance, and I was at the office yesterday when Powell got on the news, and everybody was cheering because, and I imagine mortgage offices across the country and real estate agents were doing the very same thing. It's like, this is a big victory. Like, we're done with it's almost like remember when the planes were during COVID and they were taxiing on the runway to take off with the vaccines? Right. It feels very much like a moment in time where we're all relieved. There is a change in tone at the Fed, and that may be more bullish for next year.
Yeah, I tend to agree with you. I think there's this, honestly, I was with most of us there about economic thought this year in the way that I thought that we would not see this resilience that you see in the OTVI this year. Because I thought consumer conditions were too bad.
We all did. Yeah. And look, this isn't on you. Like, I think when you looked at the consumer surveys and you looked at Biden's approval rating, which is what, like, at the end of the day, presidential approval ratings is largely an economic
100%
correlation.
No, it's all about how well am I doing.
Approval ratings was as low as Trump's. And largely because consumers felt as if conditions were deteriorating. Everyone, including us, every news outlet was talking about, this feels like a recession. Why isn't there a recession? Like and you look at all these forecasts from all the major banks, and many of them were talking about things were going to roll over. Right. We got that wrong. We as a collective people that do this got that wrong. Now, we didn't get the freight economy wrong, but we did get the broader U.S. economy. It did not play out into the broader economy the way we all expected it would.
Yeah, I think something looking forward, everybody's wondering, okay, the economic situation is looking better, but it's going to take a minute, more than likely, right, to manifest.
I mean, look, I think a couple of things are happening. One is the stock market is rallying. It's the best. I mean, I think we've had the best, from November on. It's been some of the best stock activity in almost like a decade or something. Like, we've had a real robust activity in the stock market. That drives some of the big ticket items, particularly in the upper end of the market, luxury purchases, because so much of people's sort of feeling and optimism about their own net worth is driven by their 401ks and their pension plans and their stock holdings. And that element of economic activity, of having a much stronger bullish stock market, does play out in some of consumer, particularly big ticket items that consumers are buying. And now you have a reduction in interest rates, potential, not yet, but potential interest rates. But I don't know if you saw the overnight interest rate, like how treasuries are reacting to all of this.
No.
And like, just,
did they flip?
Well, I mean, like, if you look at how fast everything's being repriced, it's pretty tremendous. It's almost like a whole year in terms of the cost of capital has been unwound, and we're back to where we were a year ago. And it's almost as if everyone's like we're all relieved. It's really interesting because I think it's going to drive housing starts, potentially builder sentiment and housing over the next, say, 24, 36 months. It's going to drive, continue on some of the big purchases, like auto is an example of that. Big ticket is a big example of that. I think that's certainly bullish because those are parts of the economy, the freight economy, that has not been participating. Like, when you look at these charts, what has been participating is things like consumer retail, the inventory burn down, and the inventory replenishment. Parts of the industrial economy, particularly related to energy, the energy ecosystem has done well. Aerospace has done well. So there's parts of the economy that have done well. Auto has actually done well relative to what we would expect. If we can get housing to really participate and join in the fun and furniture and housing, everything, and appliances and big ticket, it could be a really robust 24. it's going to really shake up things. Now, I don't know that that's going to happen. I certainly think there's a lot of concerns about whether consumers, some of the lagging effects of the interest rate cycle, tightening cycle will play out. But certainly it does give you a lot of optimism for what could happen.
Yeah, and I want to pull up the outbound tender rejection index to kind of make sure that we're level set here with everybody in the transportation service space. So you're looking at the percentage of loads that are being rejected by carriers for loads that are submitted to them by their customers, their shippers. It still has not crossed over.
Why did you have to ruin the party? We were having fun talking about all the reasons to be excited, and now you bring this up.
I bring balance to the force. So we have a tender rejection rate that is still subdued. And I guess, I was the optimism last month. I got to bring you down a little bit here. We are still below 2022. Now, I guess the thing I want to ask here is we're about to have, probably the longest stretch of sub 5% rejection rates in the history of this index. Do you think that we're going to see a little bit more percolation this year? Like if we talked about 2019, it's in the orange line. At the end, you said it, we were at the end of a pretty depressed recessionary cycle for the freight market. We saw rejection rates jump to 14% that Christmas.
You're going to. I mean, naturally, yes, I think holiday will see some increase in rejection rates. And largely it has to do with carriers going off duty.
Right.
And freight being rejected, not necessarily because of lack of capacity. It is ultimately a lack of capacity, but also orders in there that they're not going to take simply because they don't have the drivers.
It's not a permanent lack of capacity.
No, it's noise in my mind. Like, I don't pay a ton of attention to the holidays. I mean, it could go up 40% and it wouldn't change my perspective.
No, but I think you can take something away from the different holiday peaks. I mean, this year, we've had almost no holiday
No, that's a good point, is that carriers have taken about every piece of freight that they have been offered. But I do think, again, I'm not trying to stay as bullish. I am relatively bullish. If you go back to that mid-May low, that was the low paint in the tender rejection rate.
Yep.
It hasn't been continued up and to the right consistently, but we have gradually, on a moving average basis, moved up and to the right. And I think that's going to continue. I think capacity is going to bleed off. I think we have a new bid cycle for next year that's going to start to hit in March and April of next year. And carriers will have at that point had a chance I shouldn't say carriers will have a chance to reprice their freight. Shippers will have had a chance to reprice their freight. That's probably the last set of clawbacks that they will get.
Yeah.
I don't think that shippers will have another period of clawback. So if I'm a shipper, the thing that I need to be paying attention to is this is probably the last set of reductions I will get from my carrier base because the cycle will largely be over with. The second thing I need to be thinking about is what happens if, because the economy has been stronger, volumes have been stronger, but what happens if the market does continue to bleed out capacity if there's a capacity crunch? And I think I'm playing a little bit more defense than perhaps we have talked about in prior conversations. Because if there's anything about freight, no matter how good you are, no matter how good your data is, no matter how much we aspire to understand the market, there have been times when the capacity situation has happened so fast in terms of tightening. It is quite possible you could make a case and not be completely out there that there could be a capacity crunch in the second half of next year. And there are reasons to also state that it could come earlier that potentially could happen. I'm not saying that at all. I'm not predicting there's going to be a capacity crunch.
Right.
I don't think we will see a capacity crunch in the first half at all.
Right.
I think there's a potential of one in the second half, although I'm not calling for it.
Right.
But I do think the bullishness in terms of volumes, a lot of the things, we're going into an election year, which means you're going to have a lot of policy decisions that everyone's going to be posturing for politics. That's going to be interesting.
Yeah.
And so there's just a lot of sort of stuff in the background that we need to pay attention to.
So what do you think about that in terms of like noise? Like in election years, obviously there's a lot of policy, potential. Do you think that that's going to create a sustained demand environment?
I think one of the reasons that the economy hasn't rolled over this year, even though everyone that thought it was using traditional models to understand it, is A, employment's been strong, but B, we forgot about and we've talked about it a few times, but the Inflation Reduction Act and the infrastructure bill have really driven a lot of money into the economy, and a lot of manufacturing has.
Also the
Employee retention credit is another element. So we've had all this money and stimulus that's happened, but the infrastructure bill and the Inflation Reduction Act are longer term CapEx driven policy decisions and monetary decisions. And when you get into fiscal decisions, when you get into that type of issue, those things will play out over years. And so we could continue to see more funding, capital funding coming into the economy for some of these projects. And that will drive. I sat down, this was 2 weeks ago, with one of the world's largest manufacturers of cars, automotive manufacturers, big European manufacturer. And the CEO was presenting to a group of executives. And he made the point that the Inflation Reduction Act is the most important driver of nearshoring and reshoring in history. And he's like, look, we're talking about, on average, and the number was astounding, something like $8,000 or $8 billion per auto manufacturer per year is what they were getting. For every manufacturer gets $8 billion for building cars, EV cars in the United States. And he's like, that is driving so much stimulus and so much demand. He's like, we're building battery plants. We're building car plants here. We're building, his big concern was part suppliers. They don't have all the part suppliers. He's like, this is stimulating so much of the economy and manufacturing, and it's driving some of it. And I came out of there with my pretty bullish on what this means from a nearshoring and reshoring aspect that we don't think a lot about.
Yeah, I think that's interesting because it really, we have economic growth when there's a problem to solve or when there's something new.
Yeah.
The PC fueled the economy back in the 90s when we were in
the internet.
Yeah.
Sort of the early.
The internet was responsible. And then the iPhone, the smartphone was really a big driver. And then there's periods of these where we don't have a lot of innovation. But I think one of the things that we had during COVID was it created so much inefficiency and it exposed so many things in our space, one of them being the supply chain environment, where people are now motivated to get in front of some of these problems a little bit. So inefficiency drives economic production and value over time. So,
well, look, I think also the policies, if you go back to 2010, 2014, which is arguably the most stable time in freight. Boring.
Boring would be a good
It was
word.
coming off of the great financial crisis. We continue to see a steady stream of demand and a steady stream of capacity. The market was largely imbalanced. It was a really stable time. There wasn't a ton of volatility in that period of time. But what we now have is an entirely new level of government spending and stimulus into the economy to try to reshape the way that our economy operates, for better or for worse, and combined with the change from sort of interest rate policy and monetary policy. And they almost are pulling on different, sort of pulling against each other.
Push and pull, yeah.
But it is interesting because from a freight standpoint, we actually should want the fiscal stimulus. The fiscal stimulus that we're talking about in terms of industrial expansion, infrastructure build, those things actually drive a lot of forward freight demand in the future. And that's something to be bullish on, particularly as it relates to truckload and rail, because those things are sort of fundamental to our economy. And this isn't unusual. I mean, the U.S. economy, the U.S. government since World War II has had some form of stimulus in industrial activity up until the end of the Cold War. Like, it was an unusual time when in the post-Cold War cycle, we stopped putting money into big industrial ideas because everything was about free trade.
Right.
And now we're back to that. And I think that's an important part of the story.
Do you think deglobalization is going to have a significant impact in the next 12 months?
This is a very gradual,
Yeah.
I don't think in the next 12 months. Yes, it's going to be a continued line item. You're going to see Mexico and northern Mexico continue to increase. We're going to see more auto activity here. We're going to see European manufacturers that can't get proper energy and material supplies in their own country end up exploring expansion into the United States. And so it's just going to be, but this is a multi-year story.
Right.
And it's one that is, because it takes so long to be effective, it's one, just like globalization takes a long time to be effective, to actually play out the impacts of it. This is one that I think in 4 or 5 years we'll look back and be like, that was a pretty remarkable time in terms of reindustrialization of our economy.
Yeah, I think too, there's we talk a lot about the supply component, but in a market like this, where we have an abundant amount of capacity, we see a place where companies, shippers, tend to get a little bit lackadaisical in their approach to their demand management strategies. That hasn't really manifested fully here, but one of the big trends that we've talked about on some of our other stuff, Freightonomics, for instance, we talk about this return to the West Coast. Now, the Southern California market, and I want to pull up this outbound tender market share data. When we talk about globalization, deglobalization, supply chain de-risking, whatever you want to call it, a lot of that involves this nearshoring or sourcing materials from other
Before
places.
we get into this, let's explain how a tree map works. This is in Sonar.
Yeah.
Do you want to explain how this works for
Yeah. So the tree map you're looking at here, the top left is the largest market in the United States in terms of outbound market share. It is not a pure volume measure. It is simply saying the Ontario market represents 3.88% of the total outbound tender volumes in the United States. The bottom right corner is the smaller ones. Now, I filtered this for only the largest markets in the United States because the point of this chart is to show you that Ontario, from a year-over-year market share perspective, has grown 23%, while the second largest market, and sometimes these two flip, of Atlanta, has shrunk about 14%.
I mean, it's telling you a lot about one of it, I think, is, let's think about what moves into Ontario. First of all, Ontario, California is in the Inland Empire. Think about places like San Bernardino, Fontana, Colton. It's all out there. It's in that sort of second part of Los Angeles, where LA proper, Long Beach and LA is where the ports are. And you go inland and you can go 100 miles inland into the Inland Empire. And it's just warehouse after warehouse after warehouse. A lot of what drives the Inland Empire, what drives the Ontario market, are products that are already cleared customs. They're at some point, someone taking possession in an inventory, in a domestic basis, taking possession on in an inventory basis, and it's stored in warehouses and distribution centers in the Inland Empire. And what I think this is telling us, Zach, is that, look, LA, can we pull the chart up on this screen? Because I can't read that screen.
Yeah.
LA is not in that upper quadrant. Look, LA is, where's LA? You don't have LA here.
It might be off the screen a little.
Okay, I was going to say I didn't see it. But Ontario...
No, it's right there. It's right in the middle, negative 4.8%.
But it's at 3.35%.
Yeah.
This is the largest port.
Yeah.
Last year, that market was, if you go back to first quarter of last year, that market was in the top, right?
Yeah, it was right in the top five.
I think it was. And so what's really interesting about that is the fact that Ontario is telling us that what we're seeing is an inventory burn down.
Yeah.
And rail intermodal data is also demonstrating that. One of the things I think is really interesting, because why am I become bullish? And it's you have to understand that not all of our data comes from the same sources. They come from very disparate sources. So we have a couple hundred data inputs that we get in terms of types of data. The three data sources that I like to look at to understand sort of the state of the macro economy, the freight economy, is the trucking data, which is really, in our world, tender data. The intermodal data. Can we not move off that chart, please?
Oh, sorry. I was going to get you ready for the rail data.
Okay, but I'm not done with this chart.
Okay.
I'm not done with this tree map. People at home are like, what are you talking about? But what's really interesting is that the truck, rail, and container data are all saying the same thing.
Yes.
Is that the goods economy is starting to show some signs of life. The inventory burned down, as exampled through Ontario, California, largely looks like to be burned off. And we are in a state where we're going to be in a more normalized calendar next year with the benefit of easing monetary conditions. And, I tell you this, my wife and I bought we have 5 kids, so we have to have big cars, but we got this Yukon. And 3 months ago, I got an interest rate quote of 9.5% from Bank of America. We ended up buying this car this past weekend, 6.7%. Same credit profile, everything. But the banks themselves had dropped the rate by 2.8%, which I thought was pretty astounding. And what it's telling, like in a matter of months, what it's telling us, or what it's telling me, is that the banks need volume. They also, if they can lock in a 6.7% deal over, say, 5 years, then if we're on the other side of the curve, that's a really nice interest rate for them with a low credit profile. So, low risk profile. And so, from that standpoint, I think that's just an interesting data point and anecdote. Other things that we're seeing in the data, I think, you talked about Atlanta is off of that. A lot of that is like domestic consumer manufacturing, those types of things that you tend to see in Atlanta. But it does tell us that this inventory drain down is happening, is real. And I think that's pretty encouraging. Look at how far Detroit has dropped. And that's sort of a function of auto.
I think auto was having kind of a heyday. It was a delayed heyday for the auto manufacturers because supply chains cleared up and they were able to produce again.
They were, but one of the interesting things is they produced a lot of cars pre-strike.
Right.
And then now are in a situation, going back to conversation about the auto manufacturer, listen to them. One of the interesting data points they had was through October, their sales were up 11%, 10 to 11% year over year. They saw a drop off in November, and it was only at 4% year over year. But it was the luxury categories. And these are, well-known big luxury brands, like among some of the nicer brands, that was actually dropping off, not the lower end of the market, which I thought was pretty interesting.
Yeah. I mean, you talk about it here. Like, we also see Dallas showing up here, 8.4% year over year. What do you think about Texas? Are we still bullish on Texas?
Absolutely. Okay. I mean, if you're bullish on Mexico, or you're bullish if you're bullish on domestic manufacturing coming back, and this sort of concept of nearshoring and reshoring, you have to be bullish on Texas.
Yeah.
Because they're going to be the biggest winner.
Right.
Their economy is going to be the biggest winner. Like, yes, there's so many things to love about the Texas economy.
Right.
It has no geographical constraints. I mean, there are no mountains in Dallas. They can build cities, hundreds, just like Southern California.
Right.
Southern California, or California period, has a lot more geographical constraints. Like, Texas can go 1,000 miles out to El Paso, and from Dallas to El Paso, you're 600 miles. You really don't have a lot of like geography. You can go north, you can go south. Like, they can build that thing as wide as far as possible. You have a great business climate. But I think one of the other realities is its neighbor to the south is a fantastic trading partner for Texas. And it's center of the country, man. Like, it's half, it takes up a third of the country, but like, it is center of the U.S. Dallas is perfectly positioned.
It is one of the most, and this is what I tell people, like, it's the
Are you doing that? Or
I'm doing this.
Okay, you're the one doing that.
Yeah.
So I need to.
No, but I think it is a fascinating thing to see Dallas kind of, normally we talk about Texas volume in the summer. And then
it's produce and
you got produce, you got beverages, you got all sorts of stuff. And now we're still talking about Texas later in the year. And do you think that this is a component too, not just of the Mexico situation, but do you think some of this is supply chain maneuvering, like where people have set up like more staging places
go
in the middle of the country?
Go back to your tree map chart
Again.
No, but you don't have to. But go back and look at Phoenix, Arizona.
Yeah.
That big green box there. 76% growth. Like, absolutely, they're bringing things in. They've been, they can't move into California anymore. There's no space. The regulatory environment's not friendly to it. People have staged manufacturing in Arizona. They've staged warehouses in Arizona. Arizona is also a major winner. Arizona was a backwater for outbound trucking for years. It's still very well maybe.
It's still very
in terms of outbound versus inbound, but like
much less.
It was an irrelevant factor when I was dispatching trucks. It is now. I mean, look, you've got it as one of your 4 major markets. That is an unusual thing to see in my 2020 brain or 2000 brain. But Houston is also another market you could point out. It's all a lot of petrochemical. I think one of the big stories of this economy that we should talk about is the energy supply chain. Is like energy production in the United States. I think the best thing that happened for oil producers in the U.S. and I mean this in the most positive way is when the world said we can't depend on dictators and this geopolitical rift that happened really realigned the way U.S. politicians think about the importance of domestic production. And what they did was they didn't necessarily support it, they ignored it. Like the Biden administration went from we're going to shut down fossil fuels to meh, we need fossil fuels and ignored it. In the process of doing so, they've allowed that industry to prosper without a ton of regulatory new regulations that are coming into it.
And largely because we wanted control.
We wanted control. We dealt with inflation. I think the Biden administration realized that going to beg the Saudis for more production versus letting it in the U.S. it's a lot more desirable to be dealing with your domestic economy. And I think that's also been driving a lot of activity.
Yeah. Something that I think, it's funny to me because John Kingston and I used to have this conversation about how I actually used to line up the price of diesel with the freight market economy.
Yeah.
And the price of diesel has been kind of you would have thought that it was, in the toilet compared to history when we talk about historical context of where diesel moves when the freight market is in alignment. And we've seen kind of a disconnect of that.
Well, it's over the lack of refinery capacity.
Yeah.
It's not as if the government's supporting it or we're building refineries, but it does tell us, if you think about the fact that we had this sort of, back in 2020, there was this movement to get rid of fossil fuels.
Right.
That feels like people of, not everyone, but it does feel like, at least from an administration and government regulatory standpoint, there's just less conversation about that.
Right.
There's other things that people are focused on, for better or worse, that has taken them off this idea that energy is bad.
Well, they just had the conference out in Dubai where they said, we want to reduce fossil fuels, but they left some caveats in there, right?
They hosted in Dubai.
Right.
Let's get rid of fossil fuels. The reason these beautiful buildings and these resorts and all this stuff exist is because of oil. It's not going anywhere. And I think it is, but it's been an important driver of our economy. And it will continue to be an important driver of our economy. And we should be proud that we're able to produce those goods here.
Yeah.
And I think in many ways that is mitigated. We're seeing continuing oil production mitigate the cost of, mitigate inflationary impacts and potentially becomes deflationary. But also you end up in a situation where we have a healthy price of oil because of some geopolitical risks that are out there. You have a healthy price of oil that is enabling the U.S. frackers to generate a really nice profit, which enables them to invest in their production, which, this feels like a really good situation, sort of a Goldilocks situation as it relates to oil.
Yeah, I don't know what you think about the coming months here, but I guess if you had to make a prediction about the next, let's just call it the first quarter, where's the freight market?
I think it's going to be probably the same as it is today in the sense of it's going to be, I wouldn't be shocked that January surprised us. The reason I say that is we've seen some early sales of retailers becoming aggressive. We've seen some layoffs. Etsy and Hasbro have laid off people. I think the retailers are becoming more aggressive in trying to liquidate inventories. I think they're all look, this is the last holiday season. We're going to sit with all this excess inventory. Let's burn it all down. And I think what we'll see in January is we could see a bit of a surprise. January is one of these weird years that you shouldn't see an increase. We did last year. I wouldn't be shocked if we saw another head fake in January. Yeah. And I think what will happen is that we move into, it will continue to get slightly better. Mm-hmm. I think February will feel depressed, if I'm just guessing, because every February is depressing. March will feel a little bit up. Yeah. I think we'll start to see continued increase in demand. Mm-hmm. The burn-off will continue. I think we'll see a lot of carriers that will leave the market probably in January, February, March timeframe, and we'll continue to see a lot of bankruptcies. But I would say generally things are going to look up.
Yeah. So we bottomed out.
I do believe we bottomed out in May.
Okay.
I think the May we will have become the bottom of the market.
Yeah.
And we are working our way through that part of the calendar.
Fair enough. Well, I want to make sure that we get to some Q&A, so I'll toss it back over to you, Julia.
Awesome. Thanks, Zach. For folks in the audience, if you haven't already submitted your questions, remember, go ahead and enter those in. We are going to go through as many as time allows. Starting off here, this question is from Frank, who asks, what's the best metric that you're watching that would indicate a positive inflection in the freight recession?
Okay, so let's define freight recession is defined as too much capacity chasing too little freight. Well, we've talked about, I think this chart, Zach, you just passed over.
Right here.
The chart right here, if we can pull it up on screen, would be great.
OTVI versus the carrier authorities.
Yeah, I think that's the chart that I'd look at. This is probably the best definition of the freight recession, is when that orange line is well ahead, when that gap is there. I think is when you can sort of suggest that we're in a sort of a recessionary activity. I think as those lines compress and we start to see the capacity bleed off, start to really take hold, and the volume increase, when those become sort of in tandem and match, I think is when you're sort of through the broader part of the freight recession.
Yeah, for me, it's going to be the tender rejection index. It's going to be where, what I'm looking for, it's got to be where the rejection rates are we're starting to see that 6 to 7% pop in the holidays, number one.
For sure. Rejection rates are, without saying, rejection rates are the most important factor here.
Yeah.
But you're right, 6% is 6 to 8% is sort of important. If we get above 5%, that would. Have we seen 5% all year? Other than a holiday, even in the holidays?
Even in the holidays, we haven't been above 5%.
So, with the exception of what we
outside of last Christmas,
may see in a few weeks, I wouldn't take a 5% increase in Christmas season to be anything.
Yeah.
But if we see a 5% in March, then it could suggest that we're through it. And I do think we'll see that. I think we'll see firming of rejections. But I don't expect a breakout. I don't expect it to feel like a very robust. The other thing that the year-over-year comps are going to get much easier.
Yeah.
Like if you think about year-over-year activity, next year we saw a lot of capacity burn off. The economy has certainly grown year-over-year. It could be that carriers start to feel like, in a year-over-year basis, their business is better this year than it was last year.
For sure.
So sentiment could increase and should increase for folks.
Yeah.
Great. Next question is from Ted, who asks, do you think the freight improvement for 2024 can be tied to the election?
No. I think the freight improvement is tied to the fact that you had Inflation Reduction Act, the Infrastructure Bill and Inflation Act that kept the freight economy volume going at a time when, and consumers employed at a time when everything else suggested it shouldn't be that way.
Right.
And you now have a Fed, so you're going to still have the benefit of that next year. That's still going to play out. And in fact, in many ways, more so, because these big infrastructure processes early on don't involve a lot of the trucking materials.
Right.
They tend to involve the trucking materials later in that part of the build cycle. And so those materials should start to hit next year and the following year. And I think what we'll see is a lot of that will start to produce in the freight market, combined with a more accommodating Fed.
Yeah, I don't know that anything's going to happen this year specifically. I think the Trump era stuff happened after policy was implemented. We saw freight rebounds because of some of the tax incentives, and things kind of come to fruition after the fact. So I don't know that there's going to be anything.
It's about a year.
Yeah, it takes a while.
Usually a 12-month cycle before, and it'll take a year for the Fed policy switch to play out in the economy. But the reality is that the election is probably a story that's important.
Yeah.
But I don't think it's going to necessarily drive activity.
No, we're already.
You have a divided Congress and president. Like, you have this divided issue, anyways. It's not as if the Democrats or Republicans are fully in charge of everything and they can just plug the economy to get their person in. But so,
not even going to touch that one.
Great. Next question here is from Brian, who asks, do you anticipate that we'll reach peak spot levels for truckload in the next upcycle, or was COVID a one-time event?
COVID was hopefully a one-time.
Oh my God, yes.
We reached peak truckload. I don't think we'll see $4 rates for many years.
Yeah, I mean,
that was an anomaly. Like, enjoy it. Hopefully you enjoyed it while you had it, but
yeah, it would be hard to expect. I mean, I think Rachel wrote an article about, all the events that could occur that would create that environment, and they're all terrible. And they're all like a meteor hitting the earth or some sort of natural disaster environment, which is exactly what COVID was. And that's tough. That's a tough swing in volatility. And then you end up with situations like this on the back end. It's a very hard thing.
I think, honestly, the worst thing that can happen to the freight market, and I've said this, and it's not popular to say it because people hate when you say it, but like the ELD mandate that came about, everyone thought was going to be a super bullish effect. And it was for like 6 months. But it actually had a pretty nasty hangover because it drove a lot of new entrants. You had a situation with COVID where you had this massive demand surge with high rates, but that became super attractive for small truckers to enter the market, and everybody expanded. And now we're living with a really dire market. I think the Goldilocks market for truckers was 2010 to 2014, where there wasn't a lot of volatility. Things were steady on the up. You could plan your operations out. Rates were not volatile, but they were steady. You could make an honest living. You could make a profit. And I think that probably is what you will see in the next couple of years. And if that's okay, it may not feel great, but it won't feel bad. And I honestly think that's for a long-term health of the market. I think that's honestly, if I were a trucker, that's what I would want. I want consistency and lack of volatility.
Well, that's why the economists like that 2 to 3% growth rate. It's sustainable.
Steady. Because when you get really drunk and you have this, it's just like having a glass of wine at night is fine. You're great. Have too many of them, heck of a time. But you wake up the next morning and you've got a really nasty hangover. That's exactly how the freight market feels. It's like you want just enough, not too much.
Hard to do.
Perfect. This next question is from Kayla, who asks, what role do you see technology playing in this state of the industry?
That's a great question, because there's been so many stories to this in terms of look at the autonomous trucking world in terms of like autonomous trucks were going to replace drivers. And I remember doing I was featured in New York Times back in 2017 with an author that was on this whole like story about autonomous trucks coming by 2020. And he was like really trying to make the point, and I was like, look, I think it's a decade out. Like, but it is interesting how so many technologies have come in. We've seen autonomy, we've seen visibility, we've seen hydrogen trucks. A lot of these technologies have come. They're still, in degrees, still with us, but they have none of them have lived up to the hope that in any technology, including data services like we have, it hasn't lived up to the dreams of all the founders 100% of the time. And I think as founders, we have a tendency to oversubscribe all these wonderful things that this is going to do. We're selling the vision. Investors do the same thing. And the reality is that it takes a lot longer for these technologies to really make a huge impact. And I think what we're seeing right now is a reconfiguration in the technology landscape. Is that the venture cycle from 2015 to 2022 was an amazing time to be in supply chain technology because capital was free, it was freely flowing, founders could tell these fantastic stories, they got a lot of excitement, and you could build wonderful businesses out of it. That cycle is over with, and the tourists have all gone home.
Right.
Like the people throwing $600, $700, $800 million valuations on businesses that should not be worth more than 50 million, that's all gone away. And some of these businesses shouldn't have even been underwritten to begin with. Like they should have never gotten any investment. And I think all that's gone. So technology in the next phase is going to be businesses that solve real problems and businesses that are no longer based on just hype alone, but actually have quantifiable returns on investment that they can deliver to their customers. And I actually think the incumbents are going to have a really, like in many ways, we see this as like, there's a lot of noise of early startups and then the incumbents end up winning. I remember I was in payments and everybody, all these companies in the mid 2000s were going to replace MasterCard and Visa. That was like, we're going to take on MasterCard and Visa and replace your credit card. I could tell you who ended up winning the whole digitization of payments, MasterCard and Visa. And I think we'll see the same thing, is that the large established incumbents will have the opportunity to continue to innovate their businesses slowly, because they'll let all of the startups figure it out. And they'll have the opportunity to acquire things that they perhaps couldn't build or wouldn't build internally. And they'll be able to offer their existing customers. It's not to say that startups and early stage companies are not, some of these are.
Well, a lot of them get bought up and integrate.
A lot of them
into
get bought up and integrate. But they also have to pivot from being a high growth company, high burn company, to actually having a stable business model with not burn. And that is sometimes an ugly and painful process for some of these companies. We were fortunate that we had our cash scare in early 2020.
Yeah.
Like we thought we were going to run out of cash before COVID. So we didn't get super drunk on the whole COVID money flow problem and raising money, because we realized, hey, there is the potential of it going elsewhere. And I think we were uniquely positioned during COVID to have not done that. That means that we're not paying a significant price now, like some of the other companies. Not to say that our business has been flying, it's not to say that we've had a banner 2023, because that'd be an exaggeration. But it does suggest that like the certain types of businesses that were high burn, hired a lot of people, burned a lot of capital, are going to have a much more difficult time raising capital in the future. Therefore, if that's what they have been doing, is simply raising money at higher valuations, those days are over with.
Yeah, I would totally agree with all of that, because you're talking about the realignment back to value. Like you're basically saying you have to produce something for you to be worth something. And I think that's true of a lot of things. I think we go through these financial cycles where there's ample investment going on and it's too much for the space.
It's a bubble, man.
Yeah, it's all bubble driven, because people are very emotional when they start thinking about the next big Google or Apple that they could invest in.
It's a lot of FOMO. You don't want to miss out on the next big idea.
But I mean, technology, I think, is a requirement moving forward. I think the world has gotten too complicated to where you think that, you can sit back and just let things exist in this fashion.
Ryan Peterson had a great tweet last night. So he's the founder of Flexport.
Yeah.
And it was a knock on blockchain, which is sort of ironic. But I love this tweet. But his comment was, if you can't trust your vendors to maintain your data, but you were willing to trust all the people who work or use a forklift to manage your freight in these far off countries, then you may need to, we have much bigger problems. And his point was basically like, in moving freight and logistics across the world, there are so many parties involved in that this is a much bigger problem than just a data issue. It is a problem of you have to get all these parts to work together. And so his point was, feels like the wrong technology, the wrong priority versus solving other things. Moving freight's hard work.
There's a lot of moving parts.
And that's the important sort of part of the investment.
Right.
Like we have time for maybe one more question. Folks in the audience, still go ahead and submit any questions. Anything we don't get to now, we can always follow up offline. So this question is from Frank, who asks, between LTL, truckload, and freight brokers, who will benefit first when the industry turns positive?
Truckload. That's the first winner. And the reason that the truckload firms work first, that's the reason their stocks rally, is because in the early part of the cycle, the truckload companies they're assuming that there is a capacity reset. They get higher rates and they operate for about 18 to 24 months without a ton of rate pressure. They get a lot more rate power over rates and pricing power. They have plenty of freight to choose from. So the truckload carriers are the primary winners in the early part of the cycle. The brokers are the losers. They end up losing, being the losers of that. LTL was just,
They kind of got away with this last year. They kind of missed this cycle because of yellow.
Yep.
In a way. Like I was talking about this earlier with Kaylee, is the number 3 national carrier exiting kind of gave that space a little bit of a pass on feeling the brunt of this freight market.
Yeah, it certainly didn't feel it in the second half of the year.
Right.
And I think everyone even anticipating that yellow was going down.
Yeah.
That process started in June.
Yeah.
And then really the market was certainly soft in May of this year. That was the bottom of it. But they missed at least 4 to 5 months. And look, Yellow's story, I think as early as January, people were starting to ask questions about Yellow's viability. And I think it was in April or May when Walmart, it was actually at our conference, somebody told me that Walmart was already starting to pull freight or had plans to pull freight from Yellow. And so there was already companies, a lot of noise out there.
Right.
But to your point, the LTL guys missed the breadth of this down.
And some of them may disagree with that, but they don't understand. They actually were on their way to feeling the freight market bottom, and they kind of were like, wait, but these guys are leaving. And so there was all this.
Yeah, they certainly were able to have the benefit of 9% of the capacity being produced.
Super. Well, it looks like that is just about all the time that we have for today. As of course, thanks for Uber Freight for partnering with us on today's conversation. Of course, Craig and Zach, as always, thanks for being here with us and sharing your great insights. And thank you to our audience for always participating and asking such great questions and making this event really what it is. Just a quick reminder that our State of Freight webinar series does continue on next year. So mark your calendars for January 18th. We hope to see you then. Thanks, everyone.